Thank you for joining Blackfinch's 10-minute market forecast. My name is Josh, and I'm the product specialist for our listed investment solutions here at Blackfinch. And I'm joined today by Gareth Deacon, our head of multi-asset investment. So in
Morning,
terms of
everyone.
the thanks,
Sorry,
Gareth.
Josh,
So in terms
getting
of the plan of
coffee.
attack for today, I'm going to dig into recent events and look at what's caused market movements over February. And Gareth is going to tackle the market outlook looking forward. As always, please feel free to use the Q&A box at the bottom of your screens. But more importantly, don't forget you can submit questions for us to discuss in future webinars if you feel there are some hot topics for us to debate. But on to February. I think the most important region for us to discuss this month is the UK, focusing on GDP and inflation and what that's meant for investors. So just to start with CPI growth, this actually undershot forecasts and came in at 4%, same as December. And you might think that this isn't what investors want to see, as inflation didn't fall after ticking up the previous month. But don't forget that looking forward, there are some big base effects to come in from energy and other components that's going to push inflation down. So that 4% actually beat forecasts of a rise to 4.2. And it's a nice indicator to support rate cuts from the Bank of England this year. And core inflation, which excludes those volatile food and energy prices, was also unchanged at 5.1. So it's a tick in that box. And then on to GDP, we had a preliminary estimate of GDP that showed a greater than expected contraction of 0.3% in the 3 months to December. And then we saw the previous quarter shrink as well. The economy shrank by 0.1%. And as many of you know, this is what qualifies as a technical recession. However, markets reacted quite positively. The FTSE 100 was up 2% for the weekend in the 16th of Feb. And this was almost like a bad news is good news scenario. This isn't quite the normal recessionary period. We haven't had the same kind of fallout from a typical recession. If you think about the GFC, there was very incredibly high default risk of bankruptcies. And as markets have been macro driven for so long now, this recession is almost like out of the way in the mind of the consumer and the investor. And now the job's done. We've had that recession, or we're in that recession. What's next? What's looking forward? And it revives those market expectations that the Bank of England could cut interest rates as soon as June for some forecasts. But don't forget, this can change rapidly, as we've seen since the start of the year. The Bank of England governor, Andrew Bailey, he sought to downplay the GDP data before the figures had been released. And he was asserting that this recession would be very shallow and that more emphasis should be placed on more recent indicators that have shown signs of upturn, with the caveat that services inflation was still too high and there needs to be more clear evidence that wage growth is also slowing. But I think overall markets took it as a positive, a good sign. And don't forget about those PMIs, which are typically forward-looking by nature and also suggest that this technical recession could already be over if we have our optimistic hat on. And if we go over to the US, I think we need to cover earnings season once again, just to understand what's going on in markets at the moment. And the star of the show is NVIDIA. They posted crazy fourth quarter earnings. I think its net income almost increased by 700 to 800% in the same quarter to the previous year. Its share price jumped 13% in after hours trading. And NVIDIA have benefited from a crazy spending frenzy on AI and actually justified this unbelievable share price rally. As you know, a company's share price will typically follow its earnings trajectory or earnings per share. And its chips are used to create large language models for AI, and it's basically the hottest commodity on the planet at the moment. And that's what's been driving markets and giving everything a bit of a boost currently, as it's going to be a structural change. It's going to shape the planet over years to come. And anecdotally, China is also pumping money into AI startups, and they're offering vouchers that can be used to pay for important resources like your data centers that's being used to train AI. And it's because the US has restricted Chinese access to these chips. The big Chinese companies like Alibaba holding on to the resources, and it's somewhat feeding into a bit of trade tensions between the two powerhouses. And also, if you have been eyeballing news headlines, surprise, surprise, Bitcoin's back in fashion after that heavy sell-off. and it's nearly reached the level of exuberance we saw in 2021. Demand has really started to widen from the hardcore enthusiasts, and ever since the launch of this first Bitcoin ETF by BlackRock, I think its assets have surged. I think it had a one-day record of about $520 million inflow into the fund, and there was a lot of FOMO going on with what's going on with hype behind AI at the moment. And if we jump over to the right-hand side of the world and cover Asia, I think it's really important for us to focus on Japan. And it's been quite an interesting one with what's going on in the economy versus markets. So the economy contracted 0.4% quarter on quarter over the final 3 months of last year. It was worse than expected, a worse than expected slump. And it's their official entry into that technical recession. And the main cause was a lot of sluggish domestic demand. The economy itself faces some structural headwinds in the form of like capital outflows. Locals are increasing overseas investment and some weak growth. But look at your equity market. If you look at the Nikkei 225, which is thought of as your proxy for Japan's top companies, it's hovering around its highest level in 34 years. It's continued its strong performance from 2023. A lot of this has to do with the currency in terms of the yen, but also they've had some very strong and positive corporate earnings seasons. But I think, considering time, if I pause there, Gareth, and pass over to you.
Thanks, Josh. As usual, I'm just going to kind of zero in on a couple of areas we're watching closely at the moment. To start with, I'm going to pick up exactly where Josh left off, which is Japan, and he made a couple of interesting points there that I just want to focus in on. That sentiment towards the country has improved massively particularly from overseas investors, so from the likes of us. But we don't see this trend slowing. In fact, we think there's some potentially sort of further catalysts and reform that are going to keep investors interested in the region for the foreseeable future. One of the reasons that Japan has been doing so well and in sort of driving this foreign investment has been this exit from long entrenched Japanese deflationary trend that we've seen for a very long time now. This is bringing major changes in terms of behavior of Japanese corporates towards more investment and households towards directing their savings into more risky assets. But the key point Josh just touched on there is not towards their own domestic market. And this is a really interesting point. So Japanese households hold the equivalent of about 7.7 trillion US dollars on cash and deposits, according to the latest data from the Bank of Japan. They hold only 13% of their assets in equities, which is significantly lower than the 40% we see in the US and the 21% we see in Europe. But according to Morningstar, Japanese investors are investing, but they're looking towards foreign investment instead. So in January, we saw $1.2 billion go into Japanese domestic markets from Japanese investors, whereas 7.8 billion went into foreign investment focus. So we need the Japanese domestic consumer to get interested in their own market. Foreign investors, as I said, have shown this significant interest, but I think more of the sort of institutional foreign investors are waiting for that reassurance that Japanese individual investors are also actively buying their own market. The Tokyo Stock Exchange are conducting sort of major reforms aimed at improving corporate governance, stock buybacks, shareholder-friendly actions, and all of these are positives. So if we start to see this trend of the Japanese investor investing in their own country, then this could be another sort of fillip for the market. Secondly, the actions of the Bank of Japan and this exiting from their negative interest rate policy. Towards the back end of last year, they seem to be paving the way for this to happen in Q1 this year. It hasn't happened as yet. They were projecting this sort of positive trend in wage growth and inflation, and that has happened, but they seem to be waiting a little bit longer. Now, conversely, with what we've seen happen with Western developed markets and central banks, when the central bank is not following through on what the market is expecting, equities have obviously been falling as a result. Typically here, I'm talking about obviously interest rate cuts. But actually, equity markets seem quite happy to wait for the Bank of Japan. And while there is sort of one last chance for the Bank of Japan to remove their negative interest rate policy in March 19th, their next meeting is actually more likely to be April or potentially even later than that. They're just waiting for that further confirmation on wage growth and inflation. There's no reason for the Bank of Japan to hurry with this. They continue to take this balancing sort of risk management approach with their policy making, comparing the risk of sort of premature tightening against the risk of falling behind the curve. Actually, the bigger risk here is that they were tightened too soon. So actually waiting isn't a problem here, because as they're suddenly eventually getting some inflation in the country, the last thing they want to do is raise rates and stamp it out before it gets there. So there's some interesting things going on there. We don't think that this is a trend that's going to slow anytime soon. We think there's sort of further interest to come in the Japanese market. The other thing to quickly touch on is UK inflation. As we know, a large contributing factor over the past 18 months to the UK CPI numbers has been energy. The way in which Ofgem sets its price caps has been one of the key reasons that UK inflation rose higher than the US and Eurozone and appeared to be stickier. We're starting to see the reverse effects of this now. In the end of Feb, Ofgem announced their price cap for the second quarter of the year, setting it at £1,690, down from 1,928 in Q1, so down 12.3%. More importantly, this is down from the period last year when the government's energy price guarantee had to kick in to ensure that prices didn't rise up to what Ofgem were predicting at over £4,000. So given that CPI is obviously calculated on an annual basis, the significant fall we've seen in energy prices is going to be a big contributor to inflation falling sharply in the UK in the coming months. Food equally is going to continue to benefit from favourable base effects following a set of strong readings at the start of 2023. All of this is pushing towards the fact that actually UK CPI is going to drop to, if not actually meet, or get close to rather, if not actually meet, the Bank of England's 2% target in spring. And we think this is going to be really important for investors to understand why the Bank of England don't really care about that right now. Because actually, in this situation, we need to not get too caught up in the non-core elements, those food and fuel elements of CPI. Because the Bank of England stated it needs to see evidence of easing in core pressures, so everything else basically that's impacting inflation, before cutting rates. So core inflation strips out that food and fuel, and so those detractors over the coming months aren't actually going to impact the bank's decision. So there's, as I said, something important for investors to understand. There's no doubt we'll see some people questioning why Bank of England is still standing firm on rates when inflation is at target. So again, just the dynamic between the two there that's important to understand. I'll just wrap up quickly. Appreciate we're slightly over time. So dates to look out for this month. 7th of March, we've got the ECB interest rate decision expected to stay static at 4.5%. There's absolutely no chance of a cut. The market currently thinks it's going to be June for the first cut, with 3 to 4 by the end of the year. Next week, Tuesday, US inflation. Last reading was at 3.1%. It's a little bit early still even to see any solid consensus estimates from economists, and we've noticed this trend recently that economists are waiting later and later towards the print of inflation before actually putting out their forecast. So no official forecast on that one yet, and same with the UK, 20th of March, UK inflation. Again, a bit early to see any genuine consensus, but with a print of 4% last month, and obviously knowing that we're heading down in the right direction, expect that to come down a little. Also on the 20th of March, US interest rate decisions expected again, as with the ECB. There's no chance of a move. There's no chance of a move from UK, US, or Europe this month on interest rates. The market is expecting again June for the first cut, and by the end of the year, 3 to 4 cuts are expected, edging just in favour of 3. So basically, in line with what the Fed Reserve were suggesting at the start of the year, and much lower than the 5 or 6 that the market was pricing in. So the market's essentially fallen in line with the Fed. Final thing for this month, 21st of March, UK interest rates stick at 5.25%, obviously. The voting is going to be interesting to see. The market's currently expecting a no cut until August. So that would actually be 12 months since we got up to 5.25%. And by the time of the June meeting, the market's giving sort of 44% chance, but we think August is more likely right now. By the end of the year, market expecting just 2 to 3 cuts in the UK. As I said, apologies, we've gone slightly over time. There's a fair amount to get through this month, but thanks for joining us. And obviously, as you know, any questions, you know where to find us. Thanks very much.